All right, thank you everyone for braving literal thunderstorm and lightning today to be here with us this morning. And thank you to Varun, Danny, and Derek to joining us. The rain is kind of fitting in a way because we have seen a deluge of funding into venture capital, larger than we've seen in years. But not everybody is getting the mega rounds. This is a good topic for these particular founders because altogether they have raised over $500 million in funding over their lifetimes, over their company's lifetimes, I should say, and represent billions of dollars in company valuations. So I want to start with something, I think in the last couple of years, something I used to hear a lot was, if you raise funding in 2021, if you're a later stage company in that era, you need to show a path to profitability in order to raise again. That conversation seems to have died. The rule of 40 seems to be no longer applicable in this case. Is that fair? Are investors no longer asking when and how are you going to get to profitability? And I'll start with you, Varun. You guys are the most later stage of the companies here on this stage right now.
Yeah, I mean, I think for us, people ask us about this, so I don't think it's completely off the table. But we're an extremely capital-efficient business. You know, we're not burning that much money at all. We could be profitable at any moment if we wanted to, but we're prioritizing growth. We're an extremely competitive market. We're trying to win that market, and so we're going to be ambitious, and we're going to not prioritize profitability. But we have the flexibility, given how efficient our company is, to do that at any moment. So I think that just isn't as much of a concern for us, and I think we would score extremely well on like a rule of 40 metric actually at the moment.
Is that self-discipline? Like you guys want to keep to the rule of 40?
I don't really think about like the rule of 40. Incidentally, I think we would do really well on that metric. I'm more thinking about I believe in lean teams. Like I think we're very disciplined in how we hire and when we invest in growth. And we've been posting videos on LinkedIn actually about how we like think about the ROI of like our billboards or whether or not I get to go to the Super Bowl with customers. And the spoiler is I don't. And I think that kind of rigor is what has enabled us to stay really disciplined and have a very efficient kind of capital efficient business.
Yeah. How about you guys, Danny?
No, yeah, that's a great point. Of course, I think the eventual goal is to build a great business, right? So it's not like raising a loan doesn't mean anything, and the eventual goal is to build a great business. But there are different types of businesses, and each of them might require different kind of capital at different stages. Like some of them maybe need more at the beginning, some of them need more later on, right? So it's just taking everything into account. Obviously, with this new technology, right, there's a lot of like layers where you can play, and some of them just naturally require a bit more money or a lot more money, I guess, like to some extent, like at different stages.
Yeah, I'd love to hear your opinion here, because TensorWave is a lot more hardware heavy.
That's right, yeah. So our perspective is a little bit different because we are a cloud provider. We are infrastructure, right? That means it's incredibly CapEx intensive.
Yeah. You guys are based out of Las Vegas. Yeah.
Yeah, we have to build the data center. We have to buy all the GPUs up front, right? But it also means that we're generally profitable very early in the cycle. AI software companies that you've heard in the industry is much less the case. A lot of them are spending a lot of money on compute, and they haven't yet shown their profitability. But in the hardware space and in the infrastructure space, you kind of have to have your profitability baked up front.
So basically, different models, right? So early on, higher spend, profitability later on, kind of more recurring revenue later on.
Yeah.
So what is the main question that you're hearing investors asking you about at this point? Like, what is their main concern?
On our side, it's just about getting to scale as fast as we can, right? In the data center industry, especially the AI data center industry, it used to be 2 years ago, 3 years ago, that 10 megawatts was a big data center. Now you need 100 megawatts just as entry level, and you need to be talking about gigawatts in order to actually have a seat at the table, right? And that's many, many tens of billions of dollars in CapEx. And so it's just about how quickly can we achieve that scale and how can we accelerate that.
Yeah. It does seem to me that there's this like enormous competitive pressure. Elephant in the room being that all three of you are in AI, right? Like there's especially enormous competitive pressure within AI. There's so much funding going to the space. At the same time, they're all going to this like select number of companies. I think PitchBook had data in Q3 that showed it was like over 40% of the funding went to the top 10 deals of the last year to date time frame. And that used to be 15 to 20%. And I'd imagine that you feel that competitive pressure as well, even if it is more subtle.
I mean, I think that's true, but also I think that people see there's way more opportunity because in the last 10 to 15 years, like so many more people have come online, technology's advanced in so many ways, and so the opportunity is also scaled. Now, you can make an argument that there's probably too much money in the ecosystem, and there probably is, but I think they are, everyone's trying to like see which one wins, and capital is cheap at the moment, and so they have that, that prerogative. And I think for us, like people care about growth, they care about market share, they care about and doing it with strong margins and doing it efficiently. And people want to back the winner in the market, and people seem to think Clay could be that in go-to-market AI, and I think we have a strong reason for why that could be the case. But that's kind of the pressures in this space right now.
Yeah, for sure. What about you, Danny? I think context being, I think you guys are competing with like quite a few. You guys are a foundational model focused on enterprise, and that's an incredibly competitive space at the moment.
That's true. I think, as I said, I think there are like application company, infrastructure company, model company. So they have different needs. I think with respect to capital going only to, there are different sources of investments as well.
Yeah.
You could get them from financial investors, yes, but there's also like some strategic investors that could come in and help you grow. And so and they all have different considerations. Like so far, like obviously, if you're a financial investor, maybe you're interested in returns, for example. So that's maybe top of your mind. Okay, I need to get like a certain number of multiples over however many years. Strategic investors may be thinking a little bit more differently, right? So it just depends on who you're talking to, and maybe I don't know if some other companies not as obviously raised from public markets or something like they all have different considerations. But in terms of concentration of capital, that's just I think in general how, as far as I know, like most of the financial investors like operate. When there is a deal like that looks like interesting, everybody wants to get in, but like it's just like the mentality is like I'm just going to follow other people to some extent, right? No, it's true. It's like, and if nobody's like it just becomes like like natural that it's concentrated over like a fewer number of companies in general.
Yeah.
For better or worse.
Yeah, I mean, do you think it's healthy for the ecosystem to be that concentrated?
I guess it depends on how you want to look at it, right? So maybe like some people have their own objectives, so it does make sense. Like if like you want to protect yourself from risks, right? You just want to make sure you don't do something that is really bad for your fund. Yeah, I think that approach makes sense. If you want to grow an ecosystem of like really amazing companies within a certain region, right? Whether that is in North America, Asia Pacific, Europe, I think there's a better way to allocate capital than like doing something like that. But I'm not an investor, so what do I know, right?
It is, I will say though, that it's become like starting a company is like cool, and it's become like the default, as opposed to doing it maybe for like reasons of passion or like intense curiosity. And capital is so plentiful that it's very easy to do that. And I don't know if that's like the most healthy thing for the ecosystem in the long run.
Yeah, like folks are starting because they think, oh, this is the cool thing to do, let's do it.
Yeah.
But there's not enough passion to carry it through to a successful
to
company.
enjoy, yeah.
We're definitely also seeing the concentration of capital in our space, in infrastructure. I think maybe even more so on the infrastructure side. And that's because, like I said before, deploying data centers for AI, incredibly capital intensive. So in order to have a chance at succeeding, you need to get a ton of capital very quickly. And investors, they aren't going to spread that around, right? They're not going to make small bets on 20, 30 different clouds. They're going to pick a small number and make very large bets. And so we see today in the space, there's probably less than 10 clouds that have achieved some level of scale and success that are continuing to do large-scale rounds.
Yeah, it's funny. Like we are seeing, right? The rounds of 5 million or less are significantly lower, even not just AI, but across like all of venture capital at this point. Like AI is reshaping effectively how everyone invests. And to Danny's point earlier, like we're seeing a lot of different kinds of capital structures coming in as well, and they're becoming more creative structures. Do you think you've gotten to 100 million? Not everyone can get that capital. What is it, do you think, that has really gotten investors to bite, right? To give you that 100 million? Is it the talent? Is it your resume on LinkedIn, right? Is it?
It's mostly that we're winning.
It's mostly that you're winning, but how are they seeing? Like, how are you telling them that you're winning? How are you?
I mean, I just think that like it doesn't like most of these things don't. I not to simplify it, but investing is a game of FOMO basically, and I'm not trying to like that. That is just a fact of how like venture investing operates right now, and so. And when there's a pull away winner, and maybe it's all three companies here, right? Like whenever there's a winner, like capital like swarms to it because they know what the power law will dictate if they can get a piece of that and how big that can be, right? And so I think what people see is the revenue growth is extraordinary, the margins support that, and I think a lot of other things don't matter. Now, I'm proud of our team. I think our team is amazing, and I think that we're growing responsibly and all these things. But I think to be direct about it, I think a lot of investors don't care. There's so many investors that just invest behind like numbers and nothing else. And I'm not saying those are good investments, but that's the minimum it takes to get a lot of capital.
I think also, for us, having some differentiation, we early on decided we wanted to bring something slightly different to the market, something that wasn't NVIDIA in our case, right? So instead of being NVIDIA cloud number 27, we're AMD cloud number 1, right? And we're still the only ones in the world that have that focus. Having that differentiation was very helpful in getting investors excited because they've seen how the story's played out previously, and now they have an opportunity to be backing the primary provider.
Right.
Because also it's like you look at the market differently, to Darrick's point, right? I think that especially in a lot of spaces, like go-to-market tech, for example, unbelievably crowded if you look at it in a certain way. But in reality, we don't really have competition in a lot of ways also, and that's because we have a different philosophy. We're looking at the market in a different way, and a lot of go-to-market tech is about productizing certain tactics, and we're about how can we actually take a lot of the manual work and empower GTM engineers to do way more with it and like build systems that can scale the most creative ideas, and it's just a different way of looking at the problem. And maybe that's to Darrick's point on how they're looking at the problem differently too. And if you have a core insight that is actually unique, that can really separate you.
No, yeah, I think, yeah, so you mentioned like this is about winning. You mentioned it's about differentiation. I think ultimately everybody wants to, invest in a company that, can carve their own space, and then continue to grow in that space, right? So by whatever definition, like in various stages, as I said, right?
Yeah, showing that basically you are different from the other competition that you have out there.
And then you can own that space, like you can win that space, right? That's
Yeah. So this brings me to the other question I have, which is when I talk to investors nowadays, and you ask, is AI in a bubble? And this is a question that they are getting from their LPs too. What I've heard generally across the board is, it's probably overfunded, but our companies are going to be okay. Like we love our companies; they're fabulous. When you're thinking, right, and there is a lot of AI ties, a lot of ties between AI companies, ties between tech companies in this space. If funding goes down in one company, there's a potential that there's a broader ripple effect. How do you think about, right, diversification of your customer base and also diversification of like basically communicating to your investors that you can survive any AI apocalypse?
Yeah, so on our side, again, we're infrastructure, and so the economics are a little bit different. And we generally are building long-term assets, right? Long-term data centers and getting long-term leases on GPUs, right? So our customers also don't have to be all one specific type of AI company, right? We can actually service a large number of different profiles, right? So we have some ability to survive in those cases.
Yeah, I think it's. I find it that it's very difficult to actually. Sorry, I just completely lost my train of thought there.
I'll take it first. Well,
Got it.
yeah.
I'll think about it.
You
Yeah.
can try.
Yeah.
Anyway, so for us, obviously, we're a horizontal company. We make foundation models for the physical world. So we operate in multiple domains. I think it's just a matter of making sure that you actually, at the end of the day, generate a lot of values for your end users, for your customers, and as long as you can protect that, as long as they really benefit from what you bring to them, I think everything is going to be fine. So that's what we focus on.
Yeah.
I got the train of thought back.
Fabulous.
Which is
Go.
basically just that I agreed on the concerns on the AI bubble, which we're also worried about. But this is actually why we raised $100 million.
Okay, cool.
And this is why we have a very capital efficient business.
So if you raise $200 million, I'll be like, oh God, the end is coming.
Well, I think this is totally right though, actually, because it's like you raise money, you have a very capital efficient business, so that you can weather the storm. And when things go up, when things go down, if a bubble pops, whatever happens, you are in control of your own destiny. You are in command of your ship, and you can decide your fate, right? You don't want to be reliant on other people. And obviously, every business is to some degree, but capital is something you can control. Your burn is something that you can control. And so for us, like, we're in control of our destiny. We don't burn that much. We have a lot of money in the bank, and we don't need that much more primary capital. And so, of course, at some point we may raise more, but that also, by the way, creates an environment where there creates more demand for stock and clay, which makes it easier to raise capital when you don't need that much primary capital. So it all just kind of works in that cyclical way.
Yeah.
Adding to that, right, being able to achieve a certain amount of scale and a certain amount of profitability also protects, right? And so in the infrastructure space, we think what will happen is over time, the players that have achieved some minimum level of scale, a gigawatt of capacity or more over the next couple of years, they are going to be much more protected. They're going to have better margins, more profitability, and be able to weather those storms a lot better. And if you haven't achieved that scale and something happens,
Right.
you might not be in a good spot.
Right. It's a delicate balance there, right? Because I think some folks are burning a lot more than you'd expect. And so the question is, like, you might survive, but the valuation then might take a hit.
Yeah.
Yeah. How are you thinking about, and it's funny, right? There's AI companies that are raising at insane valuations. Like I turn around and I suddenly see a $2 billion company that I've never heard of in my life. And it's a spin out, right? It's a spin out basically of a really talented AI engineer or scientist from an existing company. And so like clearly investors are really paying attention to talent, right? And so how are you thinking about hiring in this moment and hiring folks that are well, in this really competitive market, really?
Well, I think that comes around to, so yes, it's a competitive market. Now, I think some of the companies here, like Darrick's in Las Vegas, we're in New York, we're not in San Francisco, right? And so I think I don't want to say we have a monopoly or anything like that, but it's certainly less competitive than it is in San Francisco, where there's a different culture around hiring, and we can kind of like create our own space, right? We have a huge priority on culture. We're a very people-driven company, and it's a very attractive place to work, and it's a very fun place to work, and it's a very creative culture, and so I think that drives it. But with hiring generally, I actually try not to make value judgments on if someone is good or if someone is bad. Our intent is like, how can we try to understand who this human is, like peek into their soul, like really get who they are as a human, the essence of that, and then get as much information as possible in the process and match that to what we need. And what I mean by that is that's why if you look at our business teams, more than half of the people are doing their jobs for the first time. We have physicists doing community work. We have farmers doing sales. We have archaeologists doing customer success. And you usually don't, and as we were talking about backstage, we have people in politics doing roles that they've never done before too. And so, but you get these underlying gritty qualities that you really prize in those humans, and you find a role that can fit that. And that, I think, is how you have like alpha and like maintain an edge in hiring, because you're finding diamonds in the rough that other people aren't considering or valuing in the same way you are.
I definitely want to echo some of that. In these times, you're not winning, especially as a startup, you're not winning talent by paying them more, right? we can't pay more than Meta. Meta's offering $100 million packages, right, for top AI engineers. It's not happening, right? So the way you win top talent is by making sure that they are aligned with the mission and vision of the company, right?
Great. Or you give them crypto and you give them tokens. Danny, I mean, so
Yeah.
okay, Danny, you're
No.
SF based, aren't you?
No, that actually is like, yes, we are the kind of company that hires these, AI researchers, AI
Yeah.
engineers,
You're-
people who go to these
you're in the
places.
heat.
Our strategy is actually, so we have a few people in the leadership position who have a lot of experience in the field, in the space. They're usually people I know, so like personal network. But our strategy in general, more broadly, is like these people get there because they started somewhere, right? Including myself. There's a lot of like great, amazing talent, amazing people who might not have the fanciest resume because they just finished their PhD or they just finished their grad school or college. But we know how to work with them. We know how to mentor them to become like one of these people that you see in a few years like in the news everywhere. So that's what we focus on actually.
Okay, so I don't know if I'm actually allowed to curse, but I'll say, is it better to work with someone, to hire someone that you do not get along with and is extremely talented, or is it better to hire someone mediocre or like at least meets the standards?
Well, neither of these people are a fit. This is I think the point I was making earlier. Like, it's not about someone is great and someone is bad in your situation. It's it's about, are they a good fit for your team? And neither of those people are a good fit, actually. Because in order to be successful in any organization, you need to have trust, and you need to have great communication, and you need to be able to build together. And you can't do that despite the circumstances of the first person. And the second person, they may not meet like the quality standards you need, and so they're not going to be a fit either. And so I wouldn't say either of those people would be a fit at like Clay. That they wouldn't be successful.
I would have to agree with that, right? Both elements are important. You have to be a good culture fit, right? If someone's not a good culture fit, it's not going to work, no matter how much you try to force it. But you also have to have a certain amount of kind of base talent. And so it's a balance between those two things. But you have to have elements of both.
I can work with anybody as long
Amazing.
as long as they're great. I think I can work with anybody. I'll make it work.
So I know we're coming to the end. We're coming to a close. I'll ask you, since you guys all raised pretty recently, do you feel like the funding environment is still abundant?
Yes.
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 There's so much money in the world. Yeah.
There's so much money. So apparently, everyone go
So much money.
fundraise. Okay, awesome. Thank you so much, everybody, for joining us today on the final day of Web Summit. It has been a pleasure, and thank you to the three of you for offering all of your insights and wisdom.
Sweet.
Thank you.
Thank you.